This is the Miller Report with senior market strategist Vince Miller from the Birch Gold Group. We're also going to be joined in a little bit by Phillip Patrick, also from the Birch Gold Group, and he'll be joining us in just a couple of moments. Vince, nice to see you.
Great to see you, Mark.
In the news, quantitative easing, QE3. What is quantitative easing to start?
Well, in short, quantitative easing is essentially an unconditional monetary tool used by the central banks to stimulate the economy.
Does it work?
Well, in theory, it should work. Normally, when there is a recession, the economy or the economy is staggering. What the Federal Reserve will do is reduce short-term interest rates in order to spur more lending and more spending. But right now, the Fed has cut interest rates almost as far as they can go, and the economy right now is still struggling. So really, the Fed can't lower interest rates anymore.
We received an email from Mr. Albert Wensler about the Fed's program of quantitative easing, and here's what he's asking. First of all, what effect is it having on the U.S. economy? And then he's been hearing a lot in the news about how the Fed has created another stock market bubble. Let's stop there and we'll pick up with Mr. Wensler's question.
Well, in theory, quantitative easing actually should work, as we said, in two ways. First, it should inject more cash into banks and allow them to lend more money. Second, it should actually lower interest rates, as we said. But, if the Fed buys up a bunch of mortgage-backed securities, for example, that should make it cheaper to borrow money to buy a house or larger ticket items. In practice, interest rates do drop. But it's hard to figure out whether this translates into a boost in the actual economy. I mean, after all, low mortgage rates can only do so much if banks are scared to buy or to loan money because of the housing bubble, and they're being tight-fisted about lending. So it almost is a counterintuitive in fact.
It would be an artificial way of boosting the economy?
Exactly. That's exactly what it is.
Let me continue with Mr. Wensler's question. How will the Fed's latest decision affect Mr. Wensler's and everybody else's 401k? Philip, welcome to the Miller Report.
Well, thank you, Mark. I think that's a very good question. And I think it's best answered with perhaps a little bit more depth here. The question is, what effect does quantitative easing have on the markets? I was reading a very interesting interview with a guy named Joshua Harris. He's co-founder of private equity firm Apollo Global Management. He stated, and I certainly believe that there's a lot of truth to this, quantitative easing, excess money and low interest rates have driven pricing of almost all financial asset to beyond what their intrinsic value might be. And I think that's the key here. By overinflating assets with cheap money, essentially there's nothing really there to back up what we're seeing in the stock market right now. Economist Michael Pento suggests that the Federal Reserve's move to eliminate its monthly asset purchasing program is ultimately going to cause a collapse in asset prices and severe recession here in the United States.
And that term is called tapering, isn't it?
Yeah, absolutely. By reducing levels of QE on a monthly basis, that is what they refer to as tapering.
How do you think the tapering is going to affect the economy? I mean, you just said recession?
Of course, yeah. When this is going to happen is really the big question. If we're really going to see tapering longer term, again, is another question that I think we'll address a little bit later on.
One of the things that we should take a look at are savings. Americans are not known for being savers, but at the same time, Americans have money stashed away in a 401k. If we have a recession, if we have more inflation, if money becomes tighter,
right,
that money won't be as valuable. Am I correct, Vince?
Well, that's true. Mark, I mean, essentially this stimulus program was supposed to boost spending going in, so obviously when they taper, it's going to reduce spending coming out. When things get more expensive, what essentially the reduction of quantitative easing, QE3, what the tapering essentially will do is it'll raise interest rates. Big ticket items will be more expensive. Housing, cars, student loans. If you have a heater and it goes out in your house, to be practical, and you have $500 in your savings account and you can't afford to replace the heater, either A, you're going to freeze, or you're going to borrow the money and you're going to make payments on the heater. So everything, the cost of living overall generally will go up.
Let me ask you a question. As the cost of living goes up, as money becomes tighter, how does that affect the price of gold?
Well, that's a very simple question. Gold has typically tracked inflation. It always has and it always will. It's a reflection of the price of goods and services. So as the cost of living increases, gold moves along with that, hence being a very, very good way to protect buying power in this sort of climate.
So the price of gold is expected to increase.
On the back of inflation, in that sort of environment, certainly.
In general, what you're saying is that we have a robust stock market currently, right now. Mm-hmm. But it's a bubble, and bubbles always burst. They break, they pop.
Correct.
And that's what's anticipated.
Absolutely. It is when you remove the stimulus, when you remove the easing, that you really start to see what the emperor looks like with no clothes, and it's not a pretty sight.
What would you advise the listener to do to save their own portfolio, their own value of money?
Well, Mark, the trend that I'm noticing is what we're seeing here is we're seeing the most conservative investors who historically made lots of money in other market sectors, such as equities, housing, in these other areas. The trend we're noticing is we're seeing them pull out of these market sectors almost altogether and literally hedging into physical metal.
I've used this term for the last couple of programs. I'm going to use it again. Gold is a hedge against inflation. For the last 25 years that I've been talking about precious metals, gold has always been a hedge against inflation.
That's absolutely true. You see the old saying, the rich get richer. And when you see countries like China and Russia, China selling off treasuries and selling off dollars and hedging into tangible assets, particularly gold and silver. As we said before, China is looking to increase its gold holdings up to 20% by 2017. We see Russia moving into hard assets as well, and we see them obviously moving away from the dollar with all the sanctions going on. So you see institutions like central banks around the world increasing their gold supply. You see countries like Germany right now requesting they've been storing their metal in the United States and in France. They want their gold back in their possession. Institutions buying physical metal. Individuals, high net worth individuals, selling off paper assets to buy gold.
It's all well and good for countries and big banks and institutions, but the average investor doesn't care about that. They care about themselves and their own family.
Well, I would say what the big guys are doing are absolutely very important for us as individuals. Ultimately, the same principles apply, just on a much larger scale. Ultimately, central governments are flocking from the dollar to protect buying power. We need to do the same here in the United States.
So the best thing to do would be to think about buying gold. A lot of people who are listening are saying, I should have bought gold 5 years ago. I should have bought it 3 years ago. It's too late. I shouldn't buy gold now. Or silver. Are they right?
No, they're wrong.
Why?
Well, it's because you buy gold to protect money, not to make money. And if you have cash dollars that are depreciating by the rate of inflation, eroding their value and their spending powers being eroded as we sit here, then you might as well convert the dead, dying dollar and put it into something that sustains value when everything else is going down. So today is the day to buy gold.
Also, gold today is at a couple of year low.
Certainly, I would argue gold today arguably is more attractive than what we saw 3.5 years ago. We've printed more money today than we have 3.5 years ago. Things like our senior debt levels, senior debt being our first priority debt, are higher today than they were in 2007. So ultimately, the reasons that people were looking at this in 2008 are not only here today, but arguably stronger and firmer.
Gentlemen, thank you very much for joining us. And if you're listening at home and you have questions that you would like to have answered about investing in gold, about gold and silver, we encourage you to send us an email at info@birchgold.com, info@birchgold.com. You can also call us at 800-355-2116. That's 800-355-2116, and speak to one of our gold specialists. And of course, you can always go to birchgold.com to find out all kinds of information, the latest information about precious metal investing. Gentlemen, Philip, welcome to the program. Vince, nice seeing you again. We'll be back next week.
Thank you, Mark.
Thank you, Mark.
I'm Mark Allen. Thanks for tuning in. We'll see you next time.